Good day, everyone. Thank you for joining us once again here at Sea Freedom Brew for our economic briefing. Today, we're going to look at the second quarter projections of GDP. But before we do that, we're going to review over the first quarter 2020 GDP with that second release that came out last week. And then we're going to look at some numbers in terms of the inflation, and then follow that up with looking at interest rates, and then how those low interest rates could potentially impact the net interest margin at financial institutions. So let's go ahead and jump right in with the first quarter GDP. The second release came out a little worse than the original, or that advanced release, at -5%. You can see here with consumers making up about 68% of the economy, they pulled off 469 basis points of GDP. So we had that be a significant impact. And we've talked about this before. We have to remember that this only incorporates just 2 weeks of a shutdown for that quarter at the end of March. So when we think about the second quarter numbers and we look at April and May being shut down for the most part across the United States, we know that this number is going to be heavily impacted. Follow that up with that investment portion that makes up 17% of the economy. If you recall, this is where businesses are investing in their capital projects as well as equipment and inventory. And we do put in there that the residential fixed assets as well, or real estate. So that pulled off 183 basis points. So both the consumer and the businesses just not spending in the first quarter, and that's going to be followed up in the second quarter to a much more significant degree. And then we have the government and net exports, imports. Both numbers are positive, but these two, the consumer and the investment portion, is what's going to drive down the overall GDP growth in the second quarter. So we look at the April Coincident Index. This is put out by the Philly Fed, and notice every single state is red for that April. It made it very easy to do the counts on this for each of the different colors. So every state in the red represents less than 1%, -1%. And if you recall, this is the GDP per state. So in April, on average for the U.S., look where we have it at -13.74%. Now, let's look at some follow-up numbers to this. The projection from the Atlanta Fed in terms of their GDPNow, they have a lot of different disclosures over here indicating that they might not be able to capture the full impact of COVID-19, but look where that number is at that -53.8%. And that's looking at their expectations or projections that their model is showing for the second quarter GDP. So significantly lower than we anticipated. That won't be out until the end of July in terms of what that number will be. So we're continuing to get expectations here, but -53.8, that is extremely aggressive. But look at where retail sales were. This is advanced retail sales for April, down 21.9%. And then we look at the overall level of inflation, also down significantly in April. You had the PCE, which is what the Fed likes to look at, down 0.39% month over month, and the CPI off by 0.44% month over month. So we have these negative overall inflation numbers. If we go back to even 2008, we see we're much lower than we were back then. How does that impact rates? Well, we know that we are in a risk-averse environment now, and we see the rates coming down sharply over the course of just this year. But look where we were on March 9th when we hit the low in the 10-year at just 0.54. We've been bouncing around here around that 70 basis points since then. But then yesterday we saw that pick up to 82 basis points. We had a little bounce. This longer end of the yield curve is going to be, I'm not going to say volatile, but it will trade within a range. The big question, though, is will the Fed step in and do some manipulation so that they can hold down these long rates for an extended period of time in order to spur on some growth and just keep the rates low, to keep borrowing costs overall low. So that would be the big question. If that happens, we can look and see how that's going to impact the bank's net interest margin, and we'll look at that in a minute. But when we look at the future of rates, oftentimes we like to look at the expected inflation to give us an indication of where rates might go. And when we see this low level of expected inflation, that would indicate that rates are going to remain at these low levels. Follow that up with the Fed statement from their last meeting on the 29th, and they continue to say that they will keep the rates low, particularly focusing here on the Fed funds rate. They will keep that low until we're well underway in the recovery. So we're talking, years potentially. You look at where we were on the last time we were down this low after the Great Recession. 83 months we stayed between 0 and 25 basis points. So we can be down here for an excess of 5 years. So we got to keep that into consideration when we're thinking about how our rates are going to be impacted, both on the yield side with our assets and on the cost side with our funding. We put this little analysis together just looking at two fairly simple regression analysis. One was just a linear and the other one just a second order polynomial. There's a lot of math behind here, but let's just focus on the numbers. At the end of the 2019, we were at yield on earning assets for commercial banks at 4.06. When we trend this against the 10-year Treasury, we know that there is a fairly strong correlation. And we look at the line of best fit for the linear regression and the second order polynomial, and we can see that if the 10-year Treasury stays down at an average of 0.7% for an extended period of time, we're looking out a year or two, we can see that the yield on earning assets could go from a 406 down to, with the linear regression, a 207, and a second order polynomial at a 387. So there's a big spread there. So we like to average different models to give us a little better of an indication. And we can see here that that average would be 2.95. So seeing the U.S. commercial bank yield on earning assets going from a 4.06 potentially down to below 3% at 295. Now when we follow that up with the cost of funds, we can see at the end of the year the cost of funds was 83 basis points. Looking at the two models, we can say that it is reasonable at the cost of funds. You look at that against the Fed funds rate, that could get back down to 0.48 or 0.49%, just under 50 basis points. If we were to use these two averages for the yielding earning assets and cost of funds, that would give us a net interest margin of 2.44, much lower than where we saw it at the end of 2019 at a 320. So we know the there's going to be a significant impact on net interest margin as we move forward if these rates stay down where they are, and my expectation is that they will. Now, this is only that, one part of the equation. We got to look at that credit risk as well, and the need to beef up our allowance for loan losses in order to stave off that net charge-offs. So we're going to talk about that in a later briefing, but let's focus on this net interest margin, because that's going to be a pretty significant impact, I think, in the shorter term, and that credit risk is going to be an impact for longer term. Typically, when we're in a recession, we come out, we have about a year until we really start to see a lot of those net charge-offs coming through. But the net interest margin could be impacted within the next 12 months. So that's what we have for you today. We look forward to seeing you again. Have a great weekend and a great day.